Welcome everyone to today's webinar on Unigestion's macro views. I'm Marielle Sexton, and I'm joined today by a couple of my colleagues from our cross-asset solutions team. Florian Ielpo, Head of Macro Research.
Hi everyone.
And Salman Baig, Portfolio Manager.
Hello.
Before we start, I just want to quickly run through some logistics. We'll walk you through a handful of slides during which you can ask questions via the chat box on your screen. We'll take some time at the end to answer questions, but if we don't get to your question today, we can follow up afterwards. If you have additional questions following the webinar, please feel free to reach out to us. With that said, let's dig into today's topic. We're going to discuss inflation prospects, both short and medium term, and their consequences over the performance of assets in the coming months. Inflation is on everyone's minds these days. So Salman, as portfolio manager, how do you see this risk for the first quarter?
Well, Meryl, if you're convinced like we are that inflation is likely to overshoot expectations this year, this quarter in particular is going to be key. It should be you can see this from sort of two different perspectives or horizons. A shorter term one, where we're trying to answer the question, how big will inflation be in 2021? But then also the longer term perspective, the longer term question, will inflation be sustained beyond 2021, beyond this year? Answering these two questions now is essential to navigating the quarter ahead in terms of macro forces. That being said, the first point to make and get out of the way is the impact of base effects. For example, U.S. inflation bottomed out in May 2020 after the CPI had declined 1% from its February level. Mechanically, as inflation reaches its longer-term trend, let's say about 2% per year, inflation between May and June of this year should surpass 3% in year-over-year terms, right? So even without any strong fundamental reasons, inflation numbers could end up looking high. However, fundamentals are also lining up. So maybe, Florian, you can walk us through what we're seeing from that perspective.
Sure. As we've already mentioned that across many of our publications, we see inflation, of course, as the result of the interaction between demand and supply factors. We think it's important to give it a good look to both elements. The pandemic has created a disruption on the supply side, and if you're looking for signs of that, just look at the producer price indices around the world. The rising PPIs are a clear sign of that, in our opinion. The multiplication of bottlenecks, production bottlenecks around the globe is creating a short-term situation that should be pushing prices higher. And that happens at a unique moment when demand is likely to further improve across the next 3 months. So we're seeing a continuation in this inflation plus matched supply side, inflation matched with an acceleration of demand. So the thing is that we are already gathering evidence of that, both from our nowcasting and newscasting indicators. Growth should show increasingly positive as we're entering into this quarter. We have seen all our numbers picking up on this information. These positive economic forces will hit the economy at a time when inflation pressures are already building up. If you look at the chart in front of us, it shows something that we find interesting, which is the historical inflation surprises as a function of the level of our inflation nowcasters. So the red bar highlights where we stand right now, and the message is the following. Our world inflation nowcaster has reached a symbolic level of 0.5 standard deviation that you don't get to see that many times in history. And that historically implies an average inflation surprise of 40 basis points. So basically, the current consensus for inflation in 2021 is 2.8%. Given the level reached by our world inflation nowcaster, we can expect that to reach up to 3.2%. So basically passing this threshold, this 3% threshold, which is actually quite symbolic. what's more, what gives us a lot of confidence also is the fact that across our inflation metrics, there is not a single component that is not pointing in that direction. There is a remarkable consistency, both in terms of countries and in terms of economic sectors that we are looking at, and they're all pointing in the direction of an inflation surprise of that magnitude. So inflation should surprise to the upside in Q2, and we think it's a message investors need to listen to, in our opinion, to navigate through the quarter ahead of us.
Sure, but why is that, Florian? I mean, 3.2% world inflation doesn't seem very high. And correct me if I'm wrong, but we've seen worse over the past 20 years, right?
Yeah, maybe if I could jump in here, you are right, Mario. We're not talking about high inflation, right? That's actually part of our tail risk scenario. Rather, our investment process sees inflation surprises as more of a market driver than inflation itself. So let's say 40 to 50 basis points of potential inflation surprise should unsettle investors, even if the actual level of the 3.2 that Florian mentioned is not extremely high. This, we think, will lead to a brisk repricing of inflation risk and consequently discount factors. The next question, though, is what is the durability of this inflation shock? Can we expect to be surprised only over this upcoming quarter, Q2, or also in the years ahead? The Fed sees this shock as transient, and we tend to disagree with that to an extent, I would say. The main reason for our disagreement is that we expect growth to be very strong for the forthcoming years. It should continue to benefit from the massive fiscal stimulation that we've seen so far, as well as the monetary context of low short-term rates. The chart in front of us here now shows the relationship between inflation in excess of its potential level and above potential growth. Now, this chart shouldn't be surprising, right? When an economy is consistently growing above its potential, slack is reduced and capacity constraints start hitting. That will naturally lead to inflation moving beyond its potential level as well. And if we look at the dashed lines, those are economists' forecasts for the next 2 years, we see that growth is expected to be strongly above trend. The resulting inflation then is expected to be about 1% over trend during the next 2 years, right? So again, that sort of 3.2% range that we've been talking about. I should mention our own growth expectations are actually higher than economists' consensus, but this chart at least provides a baseline that an inflation surprise will be with us for at least a few quarters past Q2.
Okay, so the macro message on your end is pretty clear. Higher inflation for longer and for good reasons. I mean, solid growth. What consequences could that have on markets?
Maybe I'll take this one. Basically, for us, it conveys two messages. The first message is that we may well have seen most of what investors refer to as the beta party. We expect this higher inflation situation to be curbing the enthusiasm of financial market to some extent, in a way that the beta will not basically bring the performance that we've seen over the past 6 to 9 months. The reason for that is basically that rising rates that should be coming alongside this inflation surprise, this longer term inflation surprise, should be reshuffling valuation of bonds and of equities together. That's the first element. So first element, it should slow down the performance of the beta. I'm going to come back to this thing in a couple of secs. But the second element is that should open the door to something new compared to the past, again, 9 months, which is a rising interest for less directional exposure, aka alpha positions. I'm going to just expand on the first topic, and maybe Salman, you'll be covering the alpha side with your portfolio manager eyes. if it's quite clear what should be the impact of rising rates on bonds, we all know the duration formula, I guess, especially at a time of low yields, right? Low yields brings about higher duration, all things being equal. This rising rates environment could also be detrimental to equities. Equities have a duration. The slide that should be now in front of us shows the calculated impact in terms of performance, of equity performance, price performance, I may say, of two factors. One is the change in the level of rates, 10-year rates, and another is the change in the growth rate of dividends for the year to come. This table has been derived from a simple Gordon and Shapiro model, just like by the book, and it reads as follows. Basically, a 1% increase in interest rates leads to an 8% negative performance on the equity side if dividends remain unchanged, if the dividend growth remains unchanged, okay? And this minus 8% actually can be wiped out if we see a 25% increase in dividends, right? That's how you read this table. The key message here is, compared to the fixed income investment universe, the strength of stocks is that when rates are on the rise because of the solid macro backdrop, which is pretty much the situation in which we are today, it doesn't necessarily lead to a negative performance. Basically, as dividend growth should be able, or even dividend growth expectations can offset partially the negative duration effect. And we think it's very interesting to see that with genuine numbers, which is what this page is currently showing. So all in all, given current valuations, it still looks difficult for beta exposure to show the extraordinary performance we've seen recently past the bottom of the pandemic crisis, right? That is the first element we take from this inflation outlook that we have. The second one, maybe Salman, you will expand on that, it deals with a renewed interest of alpha trades, especially on our side.
Yeah, sure. I'll sort of pick it up from there. So first and foremost, beneath the beta surface that Florian's been talking about, there's already a large dispersion taking place. So if we go to the next slide, the charts here are showing, really that this dispersion it's already here, right? So on the left, what we're looking at is the spread between the best and worst monthly performance across S&P 500 sectors, right? And the basic picture you'll see is it's that dispersion, that sector performance dispersion has rarely been so high. The last time we saw such a level was January 2000 and March 2009. So obviously January 2000, you've got the tech bubble there. In 2009, the U.S. 10-year rate had moved up from 2.2 to 3.8%, right? So this is post-GFC, and you had growth and inflation environment starting to get priced into asset prices, right? We had the recovery starting to get priced in. We think this time moves should be exacerbated given the truly unprecedented scale of stimulation at play this time around, and so that this trend should continue. The chart on the right, what we're seeing there is geographic dispersion across equity and bond markets, and that has also picked up recently. Now, given our macro backdrop that Florian's talked through, we still expect an intensification in these recent trends, in this sentiment component, if you will. Duration and defensive equity suffering, while pro-cyclical and pro-inflationary markets rising.
Could you be a little more specific in terms of which markets or asset classes?
Yeah, sure. So if we flip to the next page, next slide, you'll see what I mean in terms of markets, right? So ultimately, our exposures are driven by fundamental considerations. We like inflation-related assets because of our inflation scenario, while our growth scenario opens the door to being exposed to, pro-cyclical equities. What these charts provide is another angle or perspective on our positioning. Here we're showing the past 3 months correlation between various markets and 4 well-known factors: cross-asset trend and carry, as well as equity momentum and value. So I should say we like the first 3 of these, right? We like trend, we like carry, and we like value in the sort of current environment, and we dislike the last one, momentum. And you can see how that's also reflected in the individual markets. Commodity currencies, we think should benefit from, our core inflation scenario, but they also are benefiting from that sort of pro-trend and pro-carry features. On the other hand, we like the Indian rupee as a way to get EM exposure with low risk, but that currency also benefits from a value perspective. It's similar for inflation-sensitive energy commodities, where again we like that inflationary exposure, but it's also benefiting from a value perspective. On the flip side, again, in terms of the Indian rupee and energy commodities, they also happen to be sort of anti-momentum, right? You can see that on the bottom right chart. They've got that negative correlation to momentum, and given our sort of top-down distaste for momentum, you can see how those things align. Finally, we have a negative view on rates for all the reasons described already. And you can see again how, if you look at the bottom right, that sort of pro-momentum feature, right, that feature that we don't like, you find that in bonds, and it goes in that same direction. So this sort of dual perspective on our positioning, right, from, we've got the sort of fundamentals that we talked about, but this slide here giving you that sort of technical or sort of factor exposure perspective highlights how these views and factors are aligning, pushing us towards those markets or factors that we like, so i.e. trend, carry, and value, via commodity currencies like Norwegian krona, Canadian dollar, EM exposure through Indian rupee, cyclical equities through Japanese equities, and away from those markets or factors that we don't like, so momentum, particular sovereign bonds. What perhaps makes us different than other investors is that we don't think we've seen the end of this market dynamic, but rather we think that Q2 should really see a continuation and even intensification of these trends.
Okay, so in short, trend is your friend, momentum is your enemy. Could you maybe summarize your conclusions in terms of an asset allocation for this quarter?
Sure, I'll do this one maybe. If we flip to the next page, our audience will see the outcome of the different elements, especially the top-down element that Salman was mentioning. The macro situation, the top left box, should be that of a stage 2 of a recovery. Okay, with classic elements and unusual elements. The classics, solid growth and rising inflation. That we've been faced with factors like that in the past. Nothing really new on the macro front. What's new is that we should still be enjoying the central bank's support for the next 3 months at least. No central bank has the plan to be tapering over that period. That, given the intensity of the recovery and the intensity of the fiscal stimulation, is unusual, and that's a positive factor. Then the middle box, sentiment has recovered. It has strongly recovered over the past 9 months. When it comes to growth assets, that's quite clear, I think, to everybody's mind. And it has also showed a recovery for inflation assets as this reflation trade has been taking place basically since late November, beginning of December. Now, what we think is that we could see some volatility in the sentiment factor, as equities valuation, the last box, are now quite stretched. And this reflation, at least, is fully priced. So this move from low growth rates of inflation indices to a long-term level in terms of growth rate, which is a reflation, that's more or less fully priced, and it's not helping, I would say, valuation. All in all, we end up with 3 key directions in our investment policy that you can see at the bottom of the slide. Currently, we retain a positive tilt on growth assets, But the way we do it is by being much more selective than in the past with our investments. As Salman described it, we have a preference for value and cyclical stocks versus momentum stocks. It's quite clear. And we play that through regional indices. Now, the second element is that we remain positive on inflation assets. We are readying ourselves for this stage 2 of this inflation period. We've seen reflation. Now we need to see inflation. That is our core scenario. I hope that we've made it quite clear. We expect this past reflation to mutate into an inflation period. And there, the way we want to be exposed is by being overweight cyclical commodities, overweight commodity currencies. And we prefer a positioning like that to being overweight inflation linkers, for which we see a decent amount of pricing already of the inflation situation. Finally, also let's be quite clear about that. We remain unconvinced by the fixed income world. Fixed cash flows and inflation, they don't get along well. That's pretty clear. Even on the credit side, the spread contraction will not be profiting as much as dividends from the growth situation. Therefore, we really try to stay away from this, momentum style bond situation, duration situation. We think that's where the risk lies for the 3 months ahead of us. So once more, we've trimmed down our beta exposure. We've built up our alpha exposure. We've readied ourselves for the quarter to come, as we think investors should be waking up progressively to inflation's call in the next 3 months.
Okay, while we wait for some questions from the audience, I actually have one for you, Salman, based on some of your earlier comments. With all the ups and downs of the pandemic, how efficient have our newscaster indicators been?
Yeah, sure. So just as a reminder for our audience, we've complemented our nowcasting indicators with newscasters. These are indicators that look for evidence of recession or inflation risk in news flow from the media. Now, in the sort of current environment of economic recovery, it's helpful to take stock of what these indicators have been saying and the impact that they have on our dynamic positioning as well as performance. So just to sort of summarize in short, our newscasters have been confirming the low recession risk, high inflation risk message that our nowcasters have also been giving. The newscasters have also been doing this with remarkable stability given their historical volatility. That's helped us more firmly anchor, I'd say, our view that a pro-growth and inflation asset allocation was in order for Q1. And indeed, this dynamic tilt has been beneficial to all the investment solutions that where we utilize the newscasters. And for the moment, I should say that they haven't really budged from their good growth, high inflation orientation. So that's sort of where we are now.
Okay, looks like we have our first audience question. ARPs were heavily challenged last year, and investors are short on interest for them. Is this the case for you as well?
Maybe I'll take this one and I'll give you the economist answer. I really think it's a good question, and I'm going to answer it very straight. Our interest remains intact for ARPs, especially with the prospects of a rising inflation shock. Let me expand on that. If there is one place where we think we can find protection, we can find shelter during periods of inflation shocks, it's the ARP segment. If history can be used as a guide here, there is a remarkable evidence, I would say, that carry strategies should do particularly well during such periods of an inflation surprise. And here I'm notably thinking of Forex carry, both DM and EM actually, and vol carry, which has showed a nice track record, I would say, during the last periods of inflation surprise. By the way, and it's quite interesting, we are currently holding an overweight for these strategies in our ARPS program, And the origin of this overweight is precisely due to the inflation risk factor that we're seeing and that we're detecting with the indicators that we've been showing so far. So that's the first point. The second point I'd like to make, beyond carry, and as Salman already alluded to, there are some equity factors that have also an historical decent track record during inflation surprise periods. And there, I'm notably thinking this time of the value factor. The value factor is quite interesting. Not only value has a tendency to deliver its best performance or part of its best performance during periods of inflation surprise, but also these days, it has a carry side. It has the highest carry across the different equity factors. It still holds this carry thing, and as Salman explained, we like carry in such a period. So in short, no, we've not lost our interest in this investment universe of risk premia, and we think investors looking for diversification against an inflation shock, because there is room for looking for that, should do the same, and now is the time for that.
Okay, great. Salman, maybe you can take this next one since it's something you spoke to earlier. Can you describe your tail risk scenario and its investment implications?
Yeah, sure. I'll happy to take that one, and in the interest of time, we'll try to keep it relatively brief. Since the end of last year, we had positioned our strategies to benefit from sort of building inflation pressures, as we expected. The successful trials of vaccines to allow demand to normalize in the face of deteriorated capacity and constrained supply. But we always kept an eye out on the upside tail risk, right? That sort of massively successful vaccination programs could lead to a demand surge as wealth and income had basically recovered really strongly thanks to all the monetary and fiscal stimulus, right? So in this scenario, this sort of upside scenario, this demand wave would collide with poor supply and prices would rise dramatically, right? So a real major inflation shock. It's in such a scenario where we would expect central banks to actually move to a more hawkish stance in tone, if not in action, and that would have significant impacts for markets. Not only would sovereign bonds be under pressure, but risky assets broadly would suffer from increasing expectations of tighter monetary policy. You'd also have a slowing fiscal impulse as the case for support would evaporate. You'd also have to contend with higher discount rates and heightened volatility. So in this scenario, we would expect that reducing broad exposure by moving into cash, which at that point in time would benefit from more attractive yields, would be the sensible approach, at least until market expectations aligned to this new environment.
Okay, so we have another minute or two. Maybe we'll just have one last quick question. An audience member asks the following: coming into this quarter, rates have been trending down. Is this just smoke, or is it a meaningful trend in your view?
I'm going to answer that shortly. It's a very good question, and I'm going to answer it the following way. We think it is essential to keep in mind the still elevated level of uncertainty that surrounds the next 3 months. A word, interestingly, that has often been coming up during our investment meetings is divergence. When lacking the data to confirm a view, it's quite natural that the opinion remains split. It's nothing surprising. Surveys showing peak activity, hard data still lagging. Europe handling the vaccination campaign in a difficult way to some extent. The US in a better way. Rates down, PPI up. Leading inflation surveys up, and the CPI is still lagging. So there is room this quarter at the beginning of this quarter for reasonable doubt here. And as long as investors will not see harder evidence that inflation is here for good, we think that there will be still room for divergence, and that's pretty much what we've seen over the past couple of days. We think the next 3 months will help reduce both uncertainty and divergence. And we look at this new downtrend in rates as, for now, a short-term recess, maybe even an opportunity to accentuate our views.
Great. Well, I think we're all out of time for today, but thank you, Florian and Salman, for your time, and thank you so much to everyone in our audience for dialing in. Please reach out to us if you have any questions about today's session or if we were unable to get to your question during the Q&A. We look forward to seeing you at our next webinar. Have a great day.
Thanks. Bye-bye.
Bye-bye, everyone. Thanks.